Howdy, Jacob here. Today we're looking at ticker symbol CLBT in the software industry, 2.8 billion market cap, 2.5 billion enterprise value, headquartered in Israel, incorporated in 1999. They do a suite of solutions, allows users to collect, review, analyze, and manage digital data. Okay. Growth is very solid with immense gross margin. Great to see that. Operating margin not quite as high. They're likely reinvesting a lot. I'll have to look at their R&D and their income statement, see how that looks. But otherwise, plus 80% gross margin and growing over 10% a year on revenue side the last 4 years is all fantastic. Income statement does show a very solid increase of research and development expenses. So that's basically taking money away from today to hopefully get exponentially more down the line. And so these margins on the net interest income is quite high. So I wonder if they have a little debt that didn't show up on the enterprise value on the front sheet, but 190 million shares outstanding. I can't really tell what's happening with the increases there, but the balance sheet shows, okay, 300 million cash-like products, no short-term debt, no long-term debt. Okay, so what is this not net interest income? That's kind of peculiar. For most people, it's their debt. And so, if you have $1 billion, 5% debt, 50 mil a year, here we see that they don't actually have any long-term debt, short-term debt. Their only interest-bearing debt is this capital leases. So I would definitely have to look into that. If you're thinking about investing, figure out why there's a negative 149, negative 109 for this net interest income. Because on the operating profit side, it's pretty solid, 33 million, even with R&D spend at 84 million. So you're looking at 10% profit. You cut that in half. You add 40 million to the operating profit. Yeah, you'd get extra taxed, hit a little bit extra on taxes, but still looking at nearly 20% margins. So very solid there. Cash flow statement shows fantastic production of free cash flow. All great. Their use of cash, very heavy on the reinvestment side. Looks like they paid some weird dividend over here, but really just reinvesting right now for the last couple years, couple acquisitions. So let's start making our assumptions here. I'd say on the revenue growth side, if we're keeping it pretty consistent with history, I think 8% does seem reasonable to me. I don't want to be too optimistic since I am a fairly conservative individual, I would say, and I don't want to be too frothy with my assumptions here. And then on the margin side, probably go closer to average, maybe increase it a little bit since they're reinvesting quite a lot. I think that their future capabilities are much greater. But again, with that, I'm going to increase my discount rate because I'm creating more of a story that hasn't necessarily shown itself for a long history of time. As for share change, their stock-based compensation is 20 million, which is about 1%. So we'll say that they don't buy back any shares and just through stock-based compensation, maybe dilute owners 1%. On the terminal side, 8% growth rate, pretty solid. Let's do slightly above market average. And we're saying the company's stock price needs to fall 80% before you get the return we're looking for here. So I do think there's a lot of growth for this company. I do like a lot of what I'm seeing. However, I just don't think from a valuation standpoint, it's a price point that makes sense to me. But definitely an interesting company and one that if it does look more attractive from a price perspective, I'd love to dig deeper on it. But I hope you enjoyed the video and have a great rest of your day. Thank you.